Bueno, y en medio de la escena actual en los mercados vamos a hacer un pequeño paréntesis. Vamos a hablar de perspectivas de inversión, poniendo el foco en las small caps, poniendo el foco en oportunidades que estemos viendo en términos generales en la renta variable europea. ¿Podría la renta variable europea próximamente batir a la renta variable estadounidense? Hasta el momento ha sido Estados Unidos quien siempre ha batido al viejo continente, pero este año empezamos a ver un cambio de tendencia. Vamos a ver también cuál es la perspectiva de la gestora que nos acompaña, y de hecho tengo conmigo a dos representantes de Bellevue. Por un lado, a Birgitte Olsen, es responsable de estrategias de renta variable europea. Birgitte, thank you so much. A pleasure.
My pleasure, Marta, meeting you.
Y aparte de Birgitte, también a su lado nos acompaña Laurent Picard, es cogestor del Bellevue Entrepreneur Europe Small Caps. Thank you so much. If we talk about Europe and about United States, about how equities have performed during the last few years, the US market, of course, has been outperforming European market. But what's, Birgitte, your view for next years? Because 2023 has been a point of inflection.
You're right. It's been a lonely place being a long-only equity stock picker in Europe compared to the stellar performance in the US for the past years. Actually, if you look back the past 5 years, the S&P 500 is plus 50%, even after the correction of last year. Actually, the IBEX is down 3 or 4. I think the DAX is slightly up, but it's been an incredible discrepancy in performance between the US and Europe. And this is coming to an end. Since September, we see that for an investor in euros, it's been negative return for the S&P 500, and it's been a positive of 16% for the stock 600, and it's been even higher for European small and mid caps. I think in an environment of rising interest rates, Europe do better. For instance, a lot of the performance of the past 5 years in the S&P 500 was the re-rating of tech stocks, was also the flying high. You know, Americans dream big. We Europeans dream a lot more conservative. And I think a lot of this hot air needs to deflate. We've seen a tremendous increase in PE multiples. So the US market is 4 PE points more expensive than the European market. And now that Europe didn't completely crumble, we managed the energy crisis until now. China reopening is a positive for the open economy of Europe. And we have much less high valuation. And also the sectors, we have less tech, we have less bond proxy in the indices. So we benefit in terms of rising interest rates. I think it can continue.
Yeah, that's interesting. You talked about this reopening in China, and of course the energy crisis. We had unusual warm, and it's been positive for us and for our situation. So according to your vision, should we allocate more our portfolio to Europe?
I think Europe stands a good chance to outperform the US. Europe lives on less debt than than the US, sorry. And also our area of specialty, small and mid caps, hate leverage. So they have much less debt even. And actually our funds have super low net debt to EBITDA levels. And a third of the companies are net cash even. So I think you need to go for the strong parts of the market, which is companies which are not leveraged, companies which have strong profitability and interesting niches. So I would strongly recommend a stock picking approach. I think buying the indices in this type of volatile interest rates environment is very risky. And I do think that Europe stands a chance to continue to outperform.
You mentioned small and mid caps. Regarding Europe, small caps have been underperforming large caps for a while. So what should we expect from now on?
Yes, we had a severe drawdown in small and mid caps in 2022, and actually they went down more than 30%, which is actually the type of reaction you see in the markets. That's what we saw in the great financial crisis, no? So by the order of magnitude, it was really preparing for a severe recession. That's why we called the market in September and said that's enough. Small and mid caps actually are not in such a bad place, and they can rebound, which also happened. But the real outperformance of small and mid caps is quite recent, actually. Of course, in risk-off phases, small caps get hit more. But I think if you bar a systemic financial crisis, which I don't think will happen, actually they should continue to be a good place to be in interesting growing niches with super solid balance sheets.
Yeah, we are now in tricky situation.
I gave it a cue for the next question.
Yeah, because now we have a new monetary policy meeting here in Europe, in Frankfurt. Tomorrow, Christine Lagarde will tell us which is the great decision. 50 basis points. It was the decision announced in February. Now we have a lot of doubts. Which is your vision?
I don't know what Mrs. Lagarde will do tomorrow, but I think in terms of consistency, they need to do what they said they will do. And actually, if they do change because of the instability or the perceived instability of financial markets, that would be a big negative. So I do think that the 50 bips are going to happen, but I don't think they will quantify the next move. Mm-hmm. So, and it's been actually not very, it would have been better if they hadn't quantified the move. Mm-hmm. So like the Fed, so they have more room to sort of adapt to the situation. But central banks is all about, you have to do what you say you're going to do. No? So, and any change in course is very debilitating for the market. But I think that there's a good chance that they will revise down the inflation expectations for 2023, which when they did in December, they said it was going to be over 6%. Now, if we look at consensus, it's going down. We see 5.5, 5.2. Lower than 4% at the end of the year. So I think there's a good chance they will put a negative momentum, and deflation remains the scenario for the coming months and years.
And well, we talked superficially about the bankruptcy of Silicon Valley Bank. How could this event impact in Europe and the banking sector?
Well, the SVB was a very special bank, no, and they carried 50% bonds in their assets. And the rising interest rates are great for banks because the net interest income rises, but also the price of financial assets on your on your balance sheet is lower. And we've seen what happened to bond markets last year. So European banks, Spanish banks for instance, have much less bonds, and they have 10% bonds in their portfolios. And also the CET ratios, which are much higher, and we had all of this regulation since the great financial crisis. I think European banks are in a much better place, and then cannot be compared in the structure and the way the asset liability management was done with the Silicon Valley Bank. For me, it's a bit also a symptom of this dream big and you know, you dance as long as the music. But I think when interest rates rises, it's hot money is difficult, no? But I mean, this is a situation. We're talking about a balance sheet. The three banks which were in question in the US is, I think, 250 billion, and the asset size of the US market is 25 billion and more, a trillion and more. So I think it's containable, and the structure this specific bank had is really not comparable with the structure of European and other big banks, actually.
Yeah, the business model was really different in startups, tech startups. So
and the balance sheet as well, and the way they invested.
Yeah, that's true. Laurent, you are focused on entrepreneur companies. Why should these companies could perform better than family business in the long run?
Yeah. One point I wanted to make, the first point I wanted to make is the following. I mean, if you look at the family-owned segment, actually it returned more than 10% in average per annum over the last 15 years. That compares with the MSCI World Index, only 4.5%. So the outperformance is massive, and I must say that we are very happy to benefit from this tailwind. Then the second part, or logical part of your question is why that, and what about the future? I think the reason for that is twofold. I would say the first reason is long-term perspective, and the second one is quality. What I mean in terms of long-term perspective is the following. You have to have in mind that 70% of the wealth of these families are actually located within those listed companies. So these companies are thinking very, very long term. They are thinking in generation and not in quarters. And they are also thinking in terms of preservation of capital. And from this perspective, their interests are clearly aligned with our interest. And then in terms of quality, what I mean in terms of quality, it's from a financial perspective, those companies are stronger. Generally, they have stronger balance sheets, and their margins are also higher. And one interesting point to make on profitability is that these high profitability level does not come at the expense of R&D, because these companies are also at the same time spending more in R&D than the average in the market.
It's a strong innovation, which gives you pricing power and is very important in terms of inflation.
Exactly. Those strong financials, they are very positive for the long-term performance, but particularly also in the short term, with rates being higher and also the very strong volatility in the market.
Yeah, because they are able to
simply much more resilient in difficult times.
And how would you define your portfolio in terms of value, growth, or blend?
Yeah. So the first point I wanted to make is that we invest the money of our clients in companies that we find are undervalued. You know that investing is not only a beauty contest, and you find these undervalued companies in both the value segment, but also in the fast-growing segment. So that explains why your portfolio is quite balanced in terms of style. You will find 30% of our investment in the value segment, 50% in GARP, and a little bit less than 20% in the high-growth subsegment of the market. One last point I wanted to make on the level of interest rate, coming back to what Birgitte was saying, is that this environment is actually very positive for stock picking strategies. So of course we are currently monitoring the current challenges in the market very closely, but we are also very enthusiastic about the future prospect of stock picking, and particularly our own entrepreneur strategy.
So we will close here the interview because we are running out of time. But thank you so much, Birgitte. Thank you so much, Laurent. It's been a pleasure, and thank you for this big and great picture about in which point we are now in markets. It's been a pleasure.
Thank you.
Así que nosotros nos quedamos, como decíamos, ¿no?, con toda esta fotografía que nos están